don't we kick it off? Thanks everyone for joining. I'm Jordan Fry from the Prudent Plastic Surgeon, and I'm excited to have back by popular demand Paul Channo from Tax Planning Boutique. Um, and he is going to talk to us about first kind of the last, I guess, major big tax act, that Tax Cuts and Job Act, and what that accomplished, and then what we could potentially look forward to in 2025. Obviously, no one has a crystal ball, but it's always helpful to be thinking ahead. And, as physicians, taxes are our number one expense, far and away. And so it really behooves us to have a tax strategy that's proactive, not just reactive. And that's what Paul and his team really preach and talk about. And so I know I am excited because he's kind of showed me a little preview of what he's going to be talking about, but I'm excited to get the whole thing. So Paul, I'll let you take it away, and thanks for being here.
All right. No, I really appreciate you having us here. Thank you so much for letting me come back again. The last one was great. Last one we talked about some real estate passive and active loss, which is always good to know. But this time, something that I've been really looking forward to is talking about what's going to happen in 2025. Obviously, these are all just predictions at the moment. No one knows what's going to happen, as what you say, but I'm excited to talk about this. It's much more clear, especially after the election, and we have at least a clearer path forward than before November 5th, right? So if any of you don't know, my name is Paul Channo. I'm an enrolled agent and a certified real estate tax strategist. I'm part of Tax Planning Boutique started by Lubna Channo, who's also here. And as Jordan mentioned, I'm going to be talking to you about how the TCJA has helped us since 2018 and what can we expect in 2025, considering all the proposals that's come through our way, especially in the recent election cycle, and then what we can make the most of and what we can kind of take with a grain of salt. So the Tax Cuts and Jobs Act of 2017 is set to sunset at midnight on December 31st, 2025. Here's your guide to understanding what we might see from the new administration and from Congress. The reason I want to just discuss the past changes with you is if the TCJA does not get extended, which is definitely a huge possibility, then the law will be reverted back to the 2017 rules. Then I will discuss the proposals mentioned during this past election season, as I mentioned. And I guess I'll talk about what it takes for those proposals to get into the form of a bill and how that painful process becomes a law. So it's one of the most significant overhauls of the tax code in decades, signed into law by President Trump in December 22, 2017. Its passage marked a major legislative victory for Republicans who controlled both chambers of Congress and sought to achieve tax reform as a cornerstone of their agenda. The process of enacting the TCJA was very fast-paced, very partisan, and influenced by both political and economic considerations. While most of it reflected long-standing Republican priorities, some important provisions like the new qualified business income rules appeared completely out of nowhere. Other provisions had literally been scribbled on in the margins of the bill, believe it or not. Like most major legislation these days, the act passed on a strict party line with absolutely no Democratic support of any stage, which we see also coming through in 2025, strictly Republican, strictly partisan. Proponents argued that it would stimulate economic growth, create jobs, and make the US more competitive globally. Critics contended it unfairly benefited corporations and the wealthy. It increased the federal deficit and provided a limited long-term relief for middle-class taxpayers. Despite the intense debate, the act marked a landmark moment in US tax policy. I'm sure you'll see why soon. Now, the problem was the Republicans knew they wouldn't get enough support to pass the bill over a Democratic filibuster, so they decided to pass it through something called a budget reconciliation, which I'll explain in depth what that is, but basically that let them pass it with a simple majority in the Senate, but reconciliation bills can't increase the deficit more than 10 years out. That in turn means most of the individual provisions are scheduled to sunset after December 31st, 2025. So that sounded like a long way away when it first passed in 2017, but now Judgment Day is near, the day of reckoning is upon us. There's a lot of critics that are saying if those rules expire, 70% of Americans will see higher taxes. That's obviously unacceptable for both parties. And so the only real debate is not if the TCJA gets extended, although it's a possibility it won't, but how much of the current law will survive going forward. Is it going to be a partial extension again? Is it going to be permanent? Maybe yes, maybe no. Congressman Jason Smith, who chairs the House Ways and Means Committee, calls it the Super Bowl of taxes. It's a pinnacle moment in tax policy right now with this next year. So starting with some key changes from 2017 to 2018, the first thing, which is huge, was the lower personal rates, which I will show exactly what happened. But they started with lower personal rates almost across the board. And then standard deductions essentially doubled, although personal exemptions disappeared. A key thing to just note, whenever Congress gives us a tax break, they take something away. One hand gives, one hand takes, right? Now, the child tax credit increased, and it went up even further during the pandemic and then came back down. Congress created a new category of income, as I mentioned, called the qualified business income rules. And that was just a disadvantage to avoid disadvantaging pass-through businesses in the face of lower corporate rates. The depreciation rules changed to allow faster deductions for capital equipment like bonus depreciation. And the deduction for state and local taxes got capped at $10,000, which is huge. And finally, the estate tax exemption doubled. Now, the act also reformed the corporate tax system. We got rid of the old graduated rates that topped out at 35%, and we replaced them with a single 21% flat rate on all the income. We got rid of the corporate alternative minimum tax, and we made a bunch of technical but important changes to the way multinational corporations allocate their income to foreign countries with lower rates. But fortunately, we're not going to get deep into the foreign benefits, but this is Washington, D.C. we're talking about, where nothing is permanent. Although the corporate rate is permanent, as they say, anything can change, especially with the negotiations coming up in regards to the extension. And now just here's the biggest problem of why part of the tax law may not be extended, while some of them are. The 2017 Act already blew a hole in the budget deficit, and that was before we put $5 trillion on our national credit card to address the COVID pandemic. Right now, the Congressional Budget Office estimates that extending the Act's individual provisions will add another $5 trillion over the next 10 years. So can we even afford all the extensions? Do we have to take something back? Can we afford new cuts on top of the old cuts, like what some of the presidential candidates, like Mr. Trump, was proposing? So right now, Republicans are all over the map on those questions. Some are urging colleagues to extend the cuts and then giving more, asserting that tax cuts pay for themselves. Others, especially in the House Freedom Caucus, are taking a harder line on the deficit. And while Republicans enjoy a 3-seat advantage in the Senate, along with VP J.D. Vance to break any ties, there is a margin in the House that may be the slimmest on record. We may end up seeing them try to fit 10 pounds of tax cuts into a 5-pound bag. We have other names for what they try to do with that, but we'll stick to that for now. So don't take anything for granted. That could mean a shorter extension, as I said, or it could mean a partial extension. A great way to think about this is if DC was a reality TV competition, which provisions would get voted off the island first and which one would get the final rose, right? So diving deep into exactly what happened with the rates, the biggest change was simply cutting the tax rates. You can see the chart shows them dropping at every bracket beyond the initial 10%. So for example, the 15% bracket dropped to 12, the 25% bracket dropped down to 22, the 28% bracket dropped to 24, and so on. So if this does not get extended, we're going back to the old 2017 tax rates, which I'm sure no one wants that. Now, with some deductions and credits, the TCJA doubled the standard deduction. For 2025, that's going to be $15,000 for single filers and $30,000 for joint filers. In 2017, it was about half of that for each. So the goal was to really just eliminate as much itemized deduction filers and just have more standard deductions. And then in turn, when they give, they take. So they eliminated the old personal exemptions, which stood at about $4,000 for every filer, spouse, and dependent. They also clipped some of the itemized deductions, lowering the limit on the mortgage interest from $1 million of debt to $750,000. So what that means is, if you're applying for a loan for your personal residence, only you can still get whatever loan you want, but the deductible portion of the interest is going to be limited to $750,000 instead of that 1 million cap. So the deduction of the interest went down a little bit. That's just on the top end. Now, also a big thing was capping the state and local taxes at $10,000 and eliminating the entire miscellaneous itemized deduction category entirely. Now, with the child tax credit, it made the TCJA made it more accessible and beneficial to many families. It doubled the credit from $1,000 to $2,000 per child. It allowed up to $1,400 of that credit to be refundable, meaning families with zero tax liability could still benefit. And then it raised income thresholds for phasing out the benefit, also expanding it to more families. Before the act, the phase out was much lower for single and joint filers. Right now, it's about $200,000 for single filers and $400,000 for joint filers. And then it also added a $500 non-refundable credit for children age 17 and older, elderly parents, or other qualifying relatives. The child tax credit has had quite a journey ever since then. So for 2021, the American Rescue Plan increased it from $2,000 to $3,000, age 0 to 6. And they also increased it for ages 7 to 17, and it made it fully refundable. Several studies credit it for cutting child poverty in half. In 2014, the House passed a bill that would have raised the credit closer to those 2021 amounts. However, that bill died in the Senate. And that specific bill that happened in 2024 is actually very important, which I will bring up later in this presentation on what Congress likes to do. They love to just pack these bills together and then just send them as one package. Now, with qualified business income, we've already mentioned that this TCJA cut the top tax on C Corp income from 35% to 21%. So that's great for the C Corp, but what are you going to do for the S Corp, the partnership, and the sole proprietorships? So they created this qualified business income that lets you deduct 20% of that income calculated on an activity by activity basis from your taxable income for the year. So there's no provision for carrying over any unused amount. However, if your qualified business income for the year is below zero, you can carry the loss forward to the next taxable year. But there are 3 limits to the deduction. So in terms of eligibility, there's pass-through businesses like sole proprietorships, partnerships, S corporations, also from real estate investment trusts, publicly traded partnerships, qualified agricultural coups, but it doesn't include guaranteed payments from partnerships, and it does not include W-2 wages that you draw from your own business. And it does not also include investment income. Now, also there's income thresholds, of course. If you make too much money, basically, then this benefit phases out. You could get less than 20%, you could get none at all for 2024. So keep in mind, this is after adjustments to income and itemized deductions before you get your tax bill. So the phase out starts out for single filers at $191,950, and then for joint filers, $383,900. And then if your QBI comes from a specified service business, your deduction for that activity phases out as your taxable income grows above those same amounts. So these include businesses in medicine, businesses in law, accounting, financial services. Really, as long as the business relies on the reputation or the skill of one or more of the employees, then that's what this applies to. Now, this is a big provision that everyone loved, part of the TCJA. It's not the biggest, but it was huge. It came out of nowhere. Congress estimates that extending the QBI rules will cost the Treasury about $50 billion per year or $500 billion over 10 years, depends how you think about it. As I said, it's not the biggest, but it was a big provision. Congress loves promoting small businesses, family businesses, and these are the main beneficiaries here. So it's not just the rich because of the phase out. It's really everyone in that middle class, upper middle class, area where they want to benefit the public. So I think that the QBI rules would probably be some of the last on the chopping block if they were not going to extend it. So I think it's going to be here to stay. There might be a couple of changes, but that no one can see the future. So we'll see what happens with that. Now, everyone's favorite slide here, accelerated depreciation. So the act introduced significant changes to the rules aimed at encouraging investment in business assets. So key provisions included the bonus depreciation rate to 100% for qualified property placed in service after September 27th, 2017. And then that ends before January 1st, 2023. So this let businesses immediately deduct the full cost of eligible assets, such as machinery, equipment, and certain improvements in the year they're placed in service. The deduction phases down after 2022, decreasing annually by 20% until it reaches 0% in 2027. This year for 2025, it's 40%. 2026, if nothing changes, it's going to be 20%, and then we're going to have to kiss bonus depreciation goodbye in 2027. Also, it extended the eligibility for bonus depreciation and first-year expensing to be on used property, provided it is the taxpayer's first use of the property and it meets certain conditions. So this is where the real estate falls in. And then also, besides bonus depreciation, we have another form of accelerating depreciation, and that's called Section 179 depreciation deduction. Now, the TCJA doubled this amount. In 2017, it was 500,000. In 2018, it was $1 million. 2025, it's been inflated up to 1.25 million. Now, this expanded the definition of qualifying property to use this section to include improvements to non-residential real property, such as roofs, HVAC systems, and security systems. So overall, these changes made asset acquisition way more tax advantageous by accelerating the cost recovery, fostering investment in capital assets, and supporting economic growth. We talk about that a lot on especially the Facebook page. I know, Jordan, you have a lot of people talking about that through your other webinars too, and your podcast as well. So I'm sure all of you guys are looking at what they're going to do with this. But we'll talk about that more towards the end of the presentation. This is huge, the SALT deduction limits. So there's a $10,000 cap limit on state and local tax deductions for individuals, and that includes the residential property tax, the income tax, and the state tax. Congress really did not like this cap, and I'm sure many people who live in New York, California, New Jersey, they didn't like it either. So this is something that Trump did not want to extend. So he doesn't want to extend it in 2025, but you give and take. You take away a cap and you have to give something up too. So most Republicans favor keeping the cap. They see it as a way to limit federal subsidies for high tax states, promote fiscal discipline at the state level. But there's even representatives that are Republican from California and New York that are in Congress. And those representatives, especially the ones from competitive suburban districts who need all the votes that they can get come election time, because it's all about the votes, they'd love to bring home targeted tax savings for their voters. So there's also a fiscal context with the SALT cap. It's been a huge revenue for the Treasury Department. Capping this, of course, a lot of people are upset about it, but it was huge. It added $1.2 trillion of revenue for it. And, they're thinking maybe let's at least increase the cap to 20,000. Let's at least adjust it to inflation, but we don't know what's going to happen. As I mentioned, there's high impact to taxpayers, California, New York, New Jersey, and states like that too. And then finally, there's the estate tax. This is not something most Americans have to worry about. But if you're one of them, it can mean millions of dollars, not to you, but to your children, to your grandchildren. They'll appreciate the estate planning that you're going to put. So the United States estate tax system utilizes a unified credit exclusion, which lets you transfer a certain amount of assets without incurring a federal estate tax. So this includes both lifetime gifts at transfers at death. For 2025, that amount is just shy of $14 million. And per married couple, that's just shy of $28 million, because of course you can combine them. So that amount is high enough that the IRS receives fewer than about $10,000 estate tax returns per year, with even fewer owing actual tax. So the tax itself is a flat 40% rate of anything above that amount payable within 9 months of death. Now, of course, that amount is subject to the same expiration date as the rest of the TCJA. If there's no extension, that 14 million and 28 million is going to get cut in half. So, estate planning is huge, especially if this doesn't get extended. But in the grand scheme of things, the estate tax raises just 18 to 25 billion dollars per year, depending on which billionaire passes away, really. So that's a tiny chunk of the overall $4.5 trillion budget. And that suggests that at least extending the 2017 rules shouldn't be too hard in regards to the estate tax. Now, my favorite parts is the 2025 proposals. So President Trump and every Republican running for Congress campaigned on extending the act, and that's clearly their highest priority. But Trump, just like any politician, threw out a bunch of new proposals on the trail. So just to see what he threw out, first thing, as everyone knows, no tax on tips. At face value, this sounds like a great way to help working class servers keep more of what they earn. But it raises fundamental fairness questions. So why should we give a break to servers but not housekeepers? Why not landscapers? Why not bus drivers? And where do we draw the line when it comes to tipped workers? Do we exclude tip income for hairstylists, nail technicians, Uber drivers, etc.? And then similar issue with overtime pay. Now, that sounds like another great idea at first. Who wants to penalize people for working longer days, right? But with the proposal to eliminate tax on tips, it raises questions. And overtime, it raises questions. How do we define overtime? Would we eliminate Social Security and Medicare as well? Would we eliminate state income tax as well? Now with overtime, how do you clarify, the 40 hours of the week, So there's a lot of questions that just no one knows how to answer right now. And that's just what's crazy when President Trump throws these proposals out on the table like that. Now, he also proposed no tax on Social Security. Right now, if you file single, those benefits are tax-free until your provisional income hits $25,000. At that point, you'll owe 50% tax. Once you make a little bit more money from Social Security, you'll owe tax on 85% of the benefit. And then currently, the IRS collects about $50 billion per year from those taxes on Social Security. So that's a lot of money to lose, especially with Social Security itself being on shaky ground. And finally, he's floated creating a new deduction for interest on car loans. So that would certainly be a crowd pleaser, of course, especially considering the price of new cars have increased to about, what, $50,000, 40 to 50,000 at least is what you're getting for a new car. And creating an itemized deduction for that car loan interest would only cost the Treasury an estimated about $5 to $6 billion a year. So in the grand scheme of things, that's not that much money that the Treasury will lose out on, but it doesn't appear to be really a high priority. So I would take this one with a grain of salt. So we've talked about some proposals. Some wild cards are the corporate tax changes. So as I mentioned before, it has been permanently set to 21%, but actually in terms of negotiating power to see, okay, can we keep, can we keep some like the QBI the way it is? Can we keep bonus appreciation back at 100%? Maybe they adjusted 21% to 23%, 25%. As we know, before the TCJA, it was up to 35%. So maybe do we find a middle ground somewhere at 25 to 28? that's certainly up in the air, and definitely there's no such thing as called permanent at Washington, D.C., right? Next, trade and tariffs. So Trump loves the word tariffs. He calls it the most beautiful word in the English language. On the campaign trail, he promised to impose a general tariff of 10 to 20% on all imports, with 60% or higher rates on imports from China. The week of Thanksgiving, he promised to place an immediate 25% tariff on imports from Mexico and Canada by executive order, bypassing Congress on the first day of his administration. So crazy if it works, right? Right now, tariff revenue is only around $80 billion per year, mostly from tariffs on Chinese goods. It's been decades since tariffs made up a significant portion of federal revenues. Economists really have no idea what will happen if Trump brings them roaring back. So, I mean, currently we buy about $3.2 trillion in goods from foreign countries every year. That suggests that imposing a general 10% tariff would just be paid by the American consumer. That's the biggest deal here. So who knows exactly what income we're going to bring from tariffs, and let's see if that can offset some of the deductions that we want to take, especially from the new proposals. Now, considering these proposals, let's talk about how these can actually become law. So the first step from a proposal is a congressman or representative will take one of Trump's ideas and they'll put them in the form of a bill. So they have to be at least a member of the Senate or the House of Representatives. But bills can also be petitioned by people who recommend a new or amended law to a member of Congress that represents them. So it can be anyone that really recommends, a bill. But once the bill is introduced, it is assigned to a committee whose members will research, discuss, and make changes to the bill. So there are many different types of committees in both the House and the Senate. When the TCJA was actually first being introduced, it was initially the House Budget Committee who began working on the TCJA and then passed it to the House Ways and Means Committee. Next, the bill is then put forth before the chamber of whichever committee it was brought forth on. When the TCJA took place, it was placed in the House of Representatives first. It passed by a vote of 219 to 206 back in 2017. Now, once the bill passes one body of Congress, it goes to the other body of Congress. In this case, when it passed from the House of Representatives back in 2017, it went back to the Senate. But the thing is, not everyone in the House agrees with everyone in the Senate with that particular bill. They'll have their own set of provisions that they agree and disagree on, and the Senate will have their own provisions that they agree and disagree on. For now, the Senate version of the TCJA passed after the House passed their version, but as you can assume, they must be reconciled together. You can't just have two different versions of the same bill get passed into law. So they have to work out any differences between the two versions. And then both chambers will vote on the same versions of the bill again. If that passes, it passes to the president. So back when the TCJA was first coming up, the House passed the Senate version quickly, but there are many amendments that came up after that. So it went back and forth with amendments and technical corrections. And then, eventually it made it to the president's desk. So the president will consider the bill. He can approve the bill and sign it into law, or the president can refuse to approve a bill, which is called a veto, of course. Trump, of course, signed the TCJA into law after the House and Senate voted to approve the final version of the bill. Now, something that we're experiencing a lot is Congress may override that veto, and the reason why I bring that up is because there was a law called the Corporate Transparency Act, as we all know, and the way that bill got passed was it made it to President Trump's desk and he vetoed it, and Congress actually overrode the veto. So what happened was, so the Corporate Transparency Act, if you don't know, that is what gave us the beneficial ownership information reporting requirement for our companies. The reason that they wanted to do that was to fix the money laundering issues. But there's so much backlash on that now. Who knows, maybe that's going to be part of the tax bills that are coming up this, in 2025. Now, some options for Congress, as I mentioned earlier in the presentation, in 2017, they used budget reconciliation. That's probably how they're going to do it this time. So that's going to be the easiest, the clearest way. It provides a fast track process for considering bills to implement the policy choices embodied in the annual congressional budget resolution. So instead of needing 60 votes in the Senate like normal bills, they only need a majority, which is 51. Currently, there are 53 Republicans, 45 Democrats, and 2 independents in the Senate. The TCJA can easily be extended if at least 51 senators vote. So the difference really with this is because the bill can't be stalled by filibuster and doesn't need the president's signature. The senators are limited to 20 hours of debate on the bill's contents. That's a huge thing, which is the reason why they can do this. They can only use it either 1 or 2 times per year. That decision whether to use one or two bills will be the essential in getting the TCJA extended. So Republicans have 2 or 3, the 2 or 3 biggest problems that the Republicans have in 2025 is extending the TCJA, the southern border issues, and then the defense issues. But you have only 2 slots to use for 3 issues. So do they combine everything into one bill and just send this giant bill on the Senate, or do they split it up into 2 bills? I think that they'll split it up into 2 bills. I think they're gonna put the TCJA, the tax provisions, on its own bill. I think they'll send that through to the Senate first. Hopefully, the sooner the better, so we can plan forward for 2026. Because really, if the qualified business income goes away, if there's no bonus depreciation, we can plan around that, but we don't know what to do at this point. We don't know what's going to get extended. And the reason that this extension needs to be passed quickly is because the more the issue is delayed, the more leverage Democrats have to get the provisions they want, meaning to take out some of those provisions out of the TCJA to generate more revenue in. Their priority is to really lower the deficit on our debt. Now, they definitely might want to eliminate the SALT cap, which might sound contradictory, but maybe in turn, they get rid of the QBI, maybe they get rid of something else. So the Democrats really want to address the national debt, which, is very important. So the longer they wait, the less of the TCJA might get extended to next year. Now, with some 2025 tax planning opportunities, what can we think about at this point? We don't know what's going to happen. I guess this is more of where we can discuss some potential strategies. Obviously, we love real estate here. I think real estate strategies are here to stay. I don't see any issues personally with short-term rentals, with real estate professional strategies. I've talked about, bonus depreciation in, the last webinar with Prudent. Both sides will want to see bonus depreciation back up to 100%. The reason why I say that, earlier this presentation, I mentioned there was a child tax credit bill that was introduced in 2024 that didn't make it to the Senate. They passed the House, didn't make it to the Senate. I've said this before, the Congress loves to pack a bunch of provisions into one bill. I wish they were more efficient and they said one bill at a time with each different provision, but it doesn't work like that. So what happened in 2024 was they included the child tax credit provisions with setting bonus depreciation to hit 100% again. Now, who knows how long that was for? I believe it was for retroactively from 2023 to 2024, assuming that was going to pass mid-2024. That didn't pass. So the thing I want you to know is that was a Democratic majority, is what I'm trying to say. And the idea of only one side wants bonus depreciation, the other side doesn't, I don't see that existing. I think both sides will want to bring bonus depreciation back to 100%. And then, hopefully we'll be able to still work on our real estate strategies, while other things that we're going to talk about might not make it through. Really, if they keep those Section 179 depreciation limits the same and they extend that, I don't think there's much to worry about. We can use 179 as well in real estate. But obviously, we love bonus. Trump has obviously discussed to bring bonus back to 100%. He said this actually in the economic conferences in Detroit and Chicago. So we'll see what they come through with. Another major activity that I don't know if you guys are participating in, but this is definitely a major thing of what I'm seeing is solar activities and EV activities leaving. So the big thing is that Trump just doesn't like just to use this clean energy methods, which is fine. So we see a lot of the solar panels not being offered as much anymore. Those EV mandates are not going to be offered as much anymore. Those aren't going to be staying. Besides really putting solar panels on your house, it's not just that. There are tax credits there. There are ways to get tax credits to put energy efficient appliances in your home. That part might stay, those parts might leave. But there are actually major, partnership indications that they build solar panel farms. The limited partners can receive ordinary income tax credits or charitable deductions. So we see a shift in those type of projects where they avoid kind of those clean energy opportunities and go for something else. Now, as I said, with no tax on tips and overtime, President Trump really continued to hit hard on these proposals. And the way Trump works is he really puts something out there. He wants to see what the feedback is. And if it's good, he'll put it again. If it's not good, he'll never bring it back. He put this out there with the tips and the overtime, and everyone loved it, which is great. Everyone loved it so much that even Kamala Harris proposed it on her campaign as well. And obviously, the concern is how do you even implement that? Do you only apply it to certain industries? Now, if they don't apply to certain industries, I can promise you that Lubna and I will work very hard to see how we can classify your income as tips or some of your income maybe as overtime, because we will, and many other people will as well. So that's something that they'll have to watch out for as well. That's a huge issue that the Congress and then the IRS can definitely foresee for sure. Now, this isn't really a tax planning opportunity, but more of a peace of mind thing. But speaking of the IRS, we can surely expect the recent funding of the IRS to be canceled and reallocated to other departments. President Trump has nominated former Congressman Billy Long to be the IRS commissioner during the Trump administration. He is expected to be confirmed and is expected to clean up the IRS to be way more efficient. Now, I can tell you myself that I actually met Billy Long at a tax conference last May. He loves tax strategies, and that's not a joke. He fully supports the legal, moral, and ethical tax strategies that taxpayers can use to minimize their taxable income. He knows that there are people out there that, it's not about getting the tax bill to zero. It's about hitting their financial goals. And that's what that's what he's done before after his time as a congressman, before he was IRS commissioner. He actually was, working, he had his own practice. He'd be working with other firms when it came to some tax credits too. But we're all excited for him to see what he'll do with the IRS. I think it'll be at least a little bit cleaner. I don't know about much cleaner, but at least a little bit cleaner. Now, there are many more strategies depending on your current situation. The outcome of the extension of the TCJA, it may impact what you want to do. Maybe Congress will have to take away some of the deductions, but what will you do if Congress does not come through for you? As has happened many times before history, hopefully you're telling yourself maybe tax planning can help you when Congress will not. Now, if that's the case, you may be thinking, what's the first step in tax planning in 2025? How can I lower my tax burden? What do I have to do? And I can tell you this, no matter if you're a private practice professional or a high-income W-2, there's always potential strategies for you to use. Now, the way we help our clients with tax planning, it's really similar to going to the doctor. If you're sick, you visit the doctor, typically 3 things happen. First, the doctor examines you and diagnoses the problem. Does your stomach hurt? Maybe it's food poisoning, maybe it's something more serious like pancreatitis. Regardless, the doctors have to figure out what the problem is before they can solve it. Next, the doctor prescribes a solution. What is it going to take to fix the problem? Finally, someone has to fill that prescription. That might involve a trip to the pharmacy for medication. That might mean surgery. It might mean physical therapy. But if the problem is serious, it's not just going to fix itself. Tax planning is exactly the same way. It's the exact same model. Our diagnosis takes the form of a tax discovery session. This is going to be the form of an assessment. We're going to look at your business and personal tax returns along with any supporting documents like your profit and loss, your balance sheet, your pay stubs, etc. We're going to ask you a series of questions about your goals. We diagnose any mistakes. We diagnose any missed opportunities that might be costing you taxes where you don't have to pay. The prescription takes the form of a tax planning proposal that introduces you to the strategies you're missing. We will tell you how much we can save you in tax. Now, finally, the implementation fills the prescription. This includes guides, checklists, forms, referrals to the specialists that you need to put the strategies to work, document them properly, and audit-proof your returns. After that, we'll repeat it for next year because every year is different, especially with the TCJA extension coming in. Now, if you'd like us to diagnose your tax situation, you can schedule a tax discovery session through our website, taxplanningboutique.com/book. From there, you can select who you'd like to meet with between myself and Lubna, and we'll do exactly what I just mentioned in the previous slide. I'm looking forward to a full year of tax savings, and I hope you can join us. Thanks for having us, Jordan, and thank you to the audience for joining us. I'm happy to open discussion or answer any questions that you may have.
Yeah, thanks, Paul. That was awesome and like a very comprehensive review. Um, I think it's really interesting, and I think everything you went through just illustrates the point of why a strategy is necessary. You can't just be reactive and every, whatever March or April try to throw your taxes together, and that's where people get caught with big surprises. Um, and it's this stuff is changing. It'll be interesting to see what happens. And I think you laid out really nicely sort of where the landscape lies right now. If anyone has any questions, predictions of their own, or thoughts, please feel free. You can just unmute yourself and ask, or if you want to throw them into the chat box and I can read them out. But I think the I was going to ask about your thoughts with the QBI and the deduction. You hit that really nicely. It's always I think, like you said, and my thought about it is kind of how everything is packaged, and that's what I almost thought was like the most interesting part, and will be the most interesting as it goes forward. And hopefully those, I think we're all looking, regardless of maybe political affiliation, for some tax breaks and opportunities and things like that. And um, the way I've always looked at it is like you're trying, the government's incentivizing you to do something that they think is good, and they're rewarding you with lower taxes. And so I think regardless of administration, there are going to be those types of opportunities. Um, well, I'll come back to the question I was just about to ask. Ricky just threw it in. For 1099 income sole proprietors, do you deal with customized solo 401ks with ability to do mega backdoor Roth? How about maybe a cash balance plan? So kind of for sole proprietors and their retirement accounts and stuff like that.
Yeah, of course, we work with the financial advisor, of course. The financial advisor might have his own ideas on what to do with the money, of course, but we definitely can help you out with the tax side of things. If you have a huge tax bill coming up, this is a perfect way to get started with how to address that big tax bill. Because when that 1099 comes in, that's just going to be your ordinary income. There are many tax strategies that may apply to you. Everyone is different. But we definitely can help put some opportunities on the table for you. And it is your choice, of course, whether you want to, move forward or not. But we'll definitely be able to put, 3, 5 tax strategies on the table for you to choose from.
Awesome. While other questions come in, have you seen or thoughts anything changing in terms of the tax management of oil and gas investments? As obviously, Trump is kind of like drill, baby, drill, regardless of what you think of that. And any thoughts of like anything you foresee with the sometimes it's like solar development with a fee simple option. Obviously, solar development, as you pointed out, kind of you probably see the incentives decreasing. Do you see anything happening with those fee simple options? So I'll throw out those two questions.
Sure. So I love fee simple strategies, as long as the vendors that you're using, of course, is well vetted. That's something that we care about a lot because they can tell you anything, but really as long as they're doing the right thing, that's what matters most to us. What I see with people with partnerships doing the fee simple strategy is they're planning on shifting anyway, from solar panels to other types of projects. So I think they're already prepared to shift. I think they were expecting Trump to win. And that was the real indicator of, our solar panels going to continue. It really depends on this election. So I think now that with Trump is coming in, I think most companies should pivot very well. I mean, I'd be shocked if they didn't have a plan already, just in case that happened. I mean, they had, they knew he was going to run. So they knew the possibilities since 2023, right? So I'm sure they have other projects out there. There's always opportunities out there. And even if the fee simple, in the worst case where fee simple doesn't come back, there's other opportunities, of course, as well. But in terms of oil and gas, I don't see anything changing. Lumna has a lot of experience with oil and gas too, so she can, of course, comment on that, but I don't see anything changing. Now, if there's anything happening with Greenland, that would be very interesting to say. I hear that they wanted, make something work mostly for the minerals, actually, and just for those natural resources. So who knows what's going to happen, but I don't see anything negative happening in terms of the oil and gas.
Makes sense.
Yeah.
Ricky asked again, and Lubna responded in the chat, but how do you handle audits? Is it an extra fee? And then Lubna responded that depending on the complexity, etc. And then Michelle's asking, are you familiar with any local plans to halt solar projects, i.e. in Somerset, New York? I don't know if you guys are familiar.
We did deal with those projects, and we have multiple states projects, so we don't deal with any firm that comes in or offers these services. We have a specific firm that we've been dealing with for over 15 years, and we use it personally for our taxes as well. So they do have the projects. We sit with them, we dissect every single step of the projects, the benefits, and the in case if there's an audit, what's their plan to defend that project. But yeah, there's tons of those projects out there. You just need to be careful who you use. That's all.
Yeah, I think that makes a lot of sense. And as I've over the past years, looked at these different firms too, I think you're right. You need to make sure you vet, and especially with these alternative type things, that they have a good track record and have done this before and do things the right way. Or else you can get in a really tough spot. Here we go. What is the annual expenses involved in tax planning by your company? I don't know if that's a broad generalized one you can answer.
If you can elaborate on that, I'd happy to answer it for you. Elaborate on the annual expenses, but we work with normally businesses, individuals. We specialize with medical professionals, especially who are in private practice. But not only up to private practice. If you're a high income W-2, we help you with that as well. So, if you could elaborate on that, Nahid, we'd be happy to answer that for you.
Not sure if, and Nahid, correct me if I'm wrong. Are you asking like what's the fee for their services?
If it is,
yes.
Okay. So we are value-based, meaning depending on how much tax that we can save you. Now, Nahid's tax situation may be different from Jordan's tax situation. Maybe I could save Jordan $100,000 in tax and Nahid $200,000 in tax. So that really depends. The tax savings depends on our fees because they're value-based. So depends also the types of strategies that we do, that we may offer for you and that you want to participate in. It just depends on the complexity of your entire situation.
Makes sense.
Yeah.
Ricky has another great question. Do you think the ability to dodge the SALT cap deduction using your business as a pass-through entity will continue with the extension of the Tax Cuts and Jobs Act?
I can think anything you want me to think, Ricky. But I bet you it's up for negotiation. I think, I think they might keep it the same and keep the workarounds the same. The workarounds were really in response to the SALT cap. It wasn't offered by the TCJA. It was offered by the states, mostly, California, New York, things like that, states like that. They were offered to kind of avoid the SALT cap for those with businesses. So it really depends on what they do with the SALT cap first. If they decide to, put some more room in there, like move it to $20,000, maybe they do, remove the workaround. Maybe if they just adjust it to inflation, maybe they still keep the workaround. As I said, I can think of anything. I would like it to stay, of course. It's a great strategy for everyone, but it depends.
Can I add something about the workaround, please,
Yeah.
here, so everybody
Yeah.
can understand? The workaround will work just like itemized deductions, but will be deducted from your business,
Mhm.
from the pass-through entity, partnership, or S corporation, will be treated as a distribution in the books, will be treated as a deduction in the tax return, and it will be treated as a tax credit or tax deduction at the state return for your personal. It's a very complicated process. People sometimes they don't see the benefits, but they just want to participate in it because it generates business deductions. If you, for any case, you calculate that tax, it's each state has different rate of taxes to calculate that. If you overpay the state when you file your personal tax return, after you include that number, which is you receive either deduction or credit for it at the state. So the state will refund the money to the business, and the amount refunded will be included as an income again for the current year. So it's kind of like very complicated. That's why they call it the workaround, because it involves the business separate treatment, the books are separate treatment, and then your personal state income tax will be separate treatment. So each state is different, each law is different, so we deal with very complex situation there.
Yeah, I remember the first time I did that, and I was like so confused because I essentially just like paid them and then got a check back, and I was just like, what is the point of this?
I know, right?
Yeah, yeah. But a couple more questions. I apologize. I can't tell if it's coming through, but my kids decide to start playing hockey in the other room, and I can't go yell at them. So if you hear noises, that's what it is. Nahid asked, do you need to review last year's or last 3 years taxes for tax saving strategy? I would imagine so in the more information you have, but what do you guys usually do?
Yeah, generally it's the most recent filed, unless if you have something specific you want us to look at, we're happy to review. But generally, the most recent tax returns filed is good enough for us. Again, unless if there's some transaction that happened a while ago that you want us to look at, we can do that too.
Okay.
Yeah.
And then Frank is asking, if I decide to use your services, who files my taxes? Is my CPA still involved? Do you guys do that?
Yeah, of course. It is your preference, Frank. We're happy to work with your CPA, as long as your CPA is happy to work with us. There's always that question of, pride, when your current CPA, you don't want to use them for tax planning, which we understand. So if you want to keep him, I don't know if he's maybe your brother, maybe he's your, relative, friend, whatever it is, we're happy to work with them. That's fine with us to not do the tax return and just work with you and review the tax return with your CPA and just kind of work year round, because we work year round. We're not limited to the tax season from January to April. We constantly have calls with our clients, at like throughout the year, every month, some of them quarterly, some of them every week, some of them really. So it really depends on your situation, but it is your preference.
I want to add also something here. So we prefer, if we do the tax planning for the first year, we prefer to file the taxes. We want to enforce our ideas there, our work. Unfortunately, some of the experiences that we had before, that when we do the planning, we finish, we send it to the CPA. The CPA is not trained well to deal with these complexity, with the complexity of the strategies. So they come back to us with the questions, and then was a lot of wasting of time, our time and their time. And the client is in the middle, between us and them. So it's your preference, but our preference is to, if we do the planning for you this year, we prefer to file the tax return for you this year. At least when you move back after that to your CPA, at least they have a guidance to walk through what we did and try their best to understand it.
think that makes a lot of sense. All right, well, we're right at our time. So I just want to thank everyone for joining. And thank you, Paul and Lubna, again for your time and all the information. It's always like a master class and I learn a ton. So really thank you. Again, if anyone is looking to contact them, it's taxplanningboutique.com, as you see on the screen there. So thank you again and have a great night. And Michelle, I hope your kids are behaving a little bit more in hockey than mine are. All right. Thanks, everyone. Have a good
Okay,
night.
Thank you,
thank
everyone.
you.
Appreciate it.
Bye.